We're talking today with Richard Swart, Executive Vice President for Grow America and founding board member for the Crowdfunding Professional Association. He knows crowdfunding, so get ready to take notes.
If you're an early stage company, typically your first round of money is credit cards, personal assets, savings. You burn what you have. Then once you've run out of that money, you typically go to what's called the friends, family, and fools round, which is sort of a negative way of putting it, but until you have some traction, your initial $50,000, $40,000 is probably going to come from Uncle Bob or your friends or some fellow co-workers, people like that. So your initial tranche of money in the tens of thousands typically allows you to get launched. Then if you have some traction and you start to think that maybe it's worth an idea worth pursuing, you'll get seed money. Now seed money is the hardest money to get. Because again, you don't really have customers, you haven't validated your product yet, you're still early stage. Seed money, again, is going to be either microenterprise loans, it's going to be SBIR grants, it's going to possibly be targeted grants for universities, and there are some funds that are seed funds. This initial put the seed in the ground money to get the idea and germinate it. Again, tens of thousands of dollars, maybe up to $100,000. So after seed money, typically your first professional investor money will be angel investors. Angels are high net worth individuals. They typically work in groups, although there are solo angels. And a typical angel will put in $25,000 to $50,000 into a deal, but they typically syndicate over 5 or 10 or 20 people. So a group of angels will come together and invest your first professional tranche of money. And that's sort of the money to give your business idea legs. They take stock in your company, typically 20, 30% for the money they give you. You'll typically get less than $500,000 for that. So your valuation of your company at this point is $1.5, $2 million. With 3 to 5x multiplier means you're getting $200,000-300,000 a year revenue, and you're ready to go get angel money. So then the next stage after angel money, there might be a B and a C round. Typically you'll go back to the angel group and ask for more as you grow. But once you've reached revenues of, depending on the company, $1 million a year, $2 million a year, you may then go for venture capital money. Now, venture capital money is organized investment pools where high net worth people or organizations invest into a fund. It's a venture capital fund, and then a managing director of the fund then chooses companies to back. So you think of Andreessen Horowitz or Kleiner Perkins or the Draper Group. These are the famous venture capital firms in Silicon Valley. They typically come in the low millions for first investment, sometimes as high as 10 million. This is where you've proven your product, you've proven your market, you need to be able to expand operations. You come in after several $1 million. Then, once you're really getting a lot of traction, you'll then go for what's private equity or growth money. And that's in the tens of millions of dollars. When JetBlue needed to buy their first round of airplanes, or a company needs to build a $100 million plant. And that's a very nice problem to have, having enough market demand to need that type of money. The private equity most companies will never see.